What's going on, everyone? Shiraz Ahmed here, and today we're going to be diving deep into a financial conundrum that's as complex as a game of chess. Should you invest more or focus on paying down your debt, especially in these times of high inflation? So stay tuned to find out. All right, welcome back, everyone. So it's important to remember we're in the midst of an economic climate where inflation is more unpredictable than the ending of a good suspense novel. Now, we've had a surprise attack with the recent data showing that Canada's Consumer Price Index rose to 4.4% year over year in April of 2023. Now, it's important to clarify that this is largely impacted by the massive increase in interest rates and the domino effect that that's had on mortgage debt servicing, and eventually that translated its way down to rent prices. So in the end, this just means that the cost of living is increasing and the money in your pocket is actually worth less than it was a year ago. So how does this economic plot twist affect our age-old question of investing versus paying down debt? So let's unpack this a little bit further. Now, the first point I'm going to suggest that you pay attention to is to understand inflation. Now, inflation were the character in a movie, it would probably be the shapeshifter. Always changing, always influencing. It's critical to understand that as inflation increases, the real value of money decreases. This means the longer you hold on to debt, the more it could cost you in real terms. So the second piece of information to keep in mind is the impact of interest rates. Now, in the grand theater of finance, interest rates are like the supporting actor whose role can't be understated. Now, the Bank of Canada might hike interest rates in response to rising inflation, which would make borrowing more expensive. Therefore, in this setting, paying down debt might become a more attractive option than borrowing to invest. Now, point number 3 is income stability. Now, picture your income stability as, frankly, the anchor in the stormy sea of inflation. Now, it's a key factor when deciding whether you should focus more on investing or debt repayment. A stable income might allow you to make regular investments even in times of high inflation. Now, the fourth piece to keep in mind is risk tolerance. Now, risk tolerance is akin to your ability to weather a storm. High inflation often goes hand in hand with increased market volatility, and this could be a risk you're not willing to take. So if you're risk averse, paying down your debt could be your port in this storm. Okay, so the fifth point to keep in mind is your future financial goals. So these are like the lighthouse guiding your journey. Your decision to invest or pay down debt should be in line with these goals. For instance, if your goal is to buy a house, let's say in the next few years, paying down debt might be a better strategy. All right, point number 6, which is your debt levels. So picture high debt levels as the villain in our story, and one that makes your journey frankly challenging. High inflation can make it harder for you to service your debts, especially if your income doesn't keep up with the rate of inflation. All right, number 7, which is investment opportunities. These are like the hidden treasures in your story. High inflation can create investment opportunities. For instance, certain sectors such as real estate and commodities often do well during times of high inflation. All right, number 8, which is personal financial habits. So your financial habits are like the unique traits of your protagonist. So if you're diligent about budgeting and saving, you may be more inclined to invest even in times of high inflation. So as we've seen, deciding between investing more and paying down debt is a complex and personal one. Like choosing between a suspenseful thriller and a feel-good comedy for movie night. Each option has its pros and cons, and the best choice really depends on your individual circumstances and preferences. So there are experts like Lucia Dunn, an economics professor at Ohio State University, and she emphasized that paying down high interest debt should ultimately be a priority before considering investments. Now, with your average credit card interest rate at a whopping 23.65% in the US, and returns from investments in the US like CDs only being the math certainly seems to support this stance. The key really to remember here is that everyone's financial situation is unique, and just like your fingertips, therefore, the decision between paying down debt and investing should be made with your individual circumstances in mind. If we look at the situation through the lens of, let's say, the recent RBC economics report, this really does suggest that consumers are more likely to be paying down debt rather than investing during periods of high inflation. Now, after all, we can see the logic in that. If you'd prefer to eliminate the villainous high interest debt from your financial story so you can move on and move forward, frankly, with less burden, why wouldn't you? Now, on the other hand, let's not forget, even in the midst of high inflation, there can be golden opportunities buried for us all. So just like your protagonist might find the hidden treasure amidst their trials and tribulations. So if you are someone with a stable income, lower levels of high interest debt, and a higher risk tolerance, investing during periods of high inflation could be an intriguing plot twist for you. Now, it could offer you an opportunity to grow your wealth, especially if you focus on sectors that traditionally perform well in these types of environments. Now let's consider insights provided by the most recent CPI report that just came out a couple of days ago. It shows us that shelter costs rose by 4.9% on a year-over-year basis in April after a 5.4% increase in March. So if you're a homeowner, this actually might be a motivating factor to focus on paying down your mortgage a bit more aggressively. However, this also implies that the real estate prices may have been rising, making it an attractive investment option for those with the financial means. Now, ultimately, one thing is clear: financial decisions are not a one-size-fits-all scenario. They need to be tailored to your circumstances, much like a bespoke suit. So whether you're dealing with a Jenga tower of debt or looking for the next big investment opportunity, your actions should really be influenced by your financial goals, risk tolerance, and personal circumstances. So to summarize, when it comes to the question of whether to invest more or pay down debt during times of high inflation, there is really no definitive answer that suits everyone. It's like trying to recommend the perfect book. The answer really depends on the reader's preferences and what they hope to gain from that experience. However, by understanding the current economic landscape and keeping a close eye on inflation and interest rates, and really seeking advice from financial experts, you can navigate these, frankly, financial maze with a little bit more confidence. Remember, each financial decision you make is a step in your journey towards financial well-being. It's like turning the pages of your financial story. Each decision you make will lead you to the next chapter. Now make sure that each step you take is a conscious one, and remember that you are really the author of your financial story. I want to thank you all for staying to the end of this video. If you appreciate the content that I've been creating, please consider hitting that like and subscribe button, as it really does help out the channel. I'm also going to put my contact details at the end of this video. Feel free to reach out if you have any topic suggestions or even questions about your own individual situation. Until next time, stay safe out there, everyone. Bye for now.